Look, I need to tell you something that'll probably piss you off. There's a quote from Sir John Templeton, the guy who made 15% returns for 38 straight years, and he said these 4 words are the most expensive in investing. This time, it's different. Every single market crash, every bubble, every time regular people lose their life savings, it starts with these 4 words. And right now, they're everywhere. See, everyone remembers the dot-com crash. Everyone knows about 2008. But there's this one bubble that almost nobody talks about. The Nifty 50 bubble of the early 70s. When it popped, the market crashed 50%. Stocks didn't recover for 8 years. And the scary part? What's happening right now looks almost identical. Let me show you. Okay, picture this. It's 1969. America just won World War II 20 years ago. The economy's been growing non-stop. Suburbs are popping up everywhere. TVs in every home. Cars in every driveway. Life is good. The stock market? Up 350% since the war ended. And then Wall Street had a brilliant idea. They called it one-decision investing. Here's how it worked. You buy these 50 blue-chip stocks, companies like Coca-Cola, McDonald's, Polaroid, Xerox, IBM, and you just never sell. That's it. Buy and hold forever. They called them the Nifty 50, the stocks you could trust with your eyes closed. Sounds reasonable, right? I mean, these are real companies. They make actual products. They have earnings. They're not some sketchy startup. But here's the thing, and I need you to remember this. Whenever an investment sounds like a no-brainer, you're usually holding a grenade with the pin pulled. By 1972, things got absolutely insane. The average stock in the market traded at about 15 times earnings. Pretty normal, right? The Nifty 50? Try 42 times earnings. Let me put that in perspective. Polaroid was trading at 90 times earnings. McDonald's, 86 times earnings. Some of these companies were priced like they'd grow 30% a year forever. And here's the crazy part. Just the top 5 stocks made up 25% of the entire US stock market. 5 companies, a quarter of everything. Investors didn't even care about the valuations anymore. The thinking was, these companies are so dominant, so unstoppable, that the price doesn't matter. Just buy them. Does any of this sound familiar yet? Because it should. Then 1973 hit like a freight train. Oil prices quadrupled overnight. Nixon killed the gold standard. Inflation exploded to 11%. Unemployment doubled. And suddenly, those safe stocks, they weren't safe at all. The market didn't just correct, it collapsed, down 50% in 2 years. But here's what really hurt. The Nifty 50, the stocks you were supposed to hold forever, they got destroyed. Coca-Cola dropped 60%, McDonald's fell 70%, Polaroid down 90%. And the worst part, there was no quick recovery, no government bailout, no bounce back. The market took until 1981 to recover, 8 years, an entire decade of your life where your investments just bled. Imagine putting money in at the peak in '72. By 1982, after 10 years of waiting, you're basically back to break even. That's assuming you didn't panic sell. Most people did. Mark Twain once said, "History doesn't repeat itself, but it often rhymes." So let's talk about today. Right now, we've got the Magnificent Seven: Apple, Microsoft, Nvidia, Tesla, Amazon, Meta, and Google. These 7 companies make up 36% of the S&P 500. 7 companies. And check out these valuations. Google and Meta 28 times earnings. Not terrible, honestly. Amazon 35x. Microsoft 38x. Nvidia 50x. And Tesla 247 times earnings. Back in 1972, everyone said Xerox would dominate paperwork forever. Polaroid would own photography. These companies were too big to fail. Today, people say the same thing about AI, about cloud computing, about electric vehicles. These 7 companies are different. They're tech companies, they're growing faster, they have network effects. There are those 4 words again. The warning. Don't be a statistic. Look, I'm not saying sell everything tomorrow. I'm not saying these companies are going to zero. But Warren Buffett said it best. What we learn from history is that people don't learn from history. When you've got extreme concentration, 7 stocks holding up a third of the market, and valuations that only make sense if everything goes perfectly for the next decade, that's not investing. That's hoping. The ghost of 1973 isn't haunting Wall Street. It's following your portfolio. And those 4 words, "this time it's different," they're the most expensive words in the English language. History's watching, and based on the last 50 years, it's betting against you.